Hello there, AT&T employees, and welcome. Thanks so much for watching with us. My name is Sam, and I will be your moderator today. Happy summer. We hope you're enjoying your summer wherever you are today. In just a second, we're going to be joined by Wesley Boudreaux, one of our senior financial advisors. Wesley's actually joining us from his RV today, trying to get in the last bit of sunshine and vacation time that he can with his family, and we appreciate that he's still working, even from the road. Before Wesley comes on, I'd like to just very quickly remind you we are not affiliated nor endorsed whatsoever by AT&T. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along today. Throughout the presentation, I will be entering some links into the chat. I invite you to pop that open. They will guide you to several different resources we have available for you, one of which may simply be the link to the AT&T Focused Retirement Guide. Another may be a link to book an appointment with Wesley or one of his colleagues if you wish after this presentation has ended. After the presentation, Wesley will be sticking around to answer any questions that may have come through the Q&A box. I invite you to ask away. If you find you have any questions while he's speaking, it's completely anonymous and we try to answer as many as we can, time permitted, of course. Wesley will answer some live, and what he doesn't get to, I promise we will address either through email or through a phone call with one of our AT&T focused advisors after this presentation. And with that, I am going to now turn your attention to Wesley Boudreaux.
All right, thank you very much for that introduction, Samantha. And as you can see, I'm actually trying to, in the summer here, get a little bit more traveling in the RV. So I'm going to go ahead and, instead of trying going back and forth with the camera here, if we get any questions come through, I'll try and take care of those. But again, we're going to be talking about some tax changes, how 2024 is coming so far. We're about halfway through the year, so we'll talk a little bit about getting ready for tax season coming up next year. We're kind of in the middle of it for some of you that may have filed extensions. We'll also talk about some different strategic planning options to take a look at. Make sure you've got a plan in place, and we'll remind you who the retirement group is and where we can actually come into play and help you with some of these items as well. So first and foremost, we'll go over standard deduction increases, marginal tax rates, no changes really there. The retirement contributions, some increases we're seeing there as well. Estate and gift tax changes, increases again, mostly just for inflationary purposes here. But we'll also talk a little bit about some of the potential changes we'll see for 2026 if there's no permanency in the Trump tax changes we had previously. We'll also talk about some special tax provisions that may affect some of you, but obviously there's a whole lot to go into here. So you can always give us a call to talk at some of these one-on-one. So first and foremost, some of the bumps in standard deductions have gone up quite a bit with inflation in this case. Those of you that are single or filing separate, actually it's gone up to $14,600. For those of you that are married, it's gone up to $29,200. So that's almost $30,000. So again, a lot of people may not itemize anymore because of this, and also because of limitations on SALT taxes like state and local taxes and things of that nature. But in some cases, if you do itemize, it's important to kind of review that, in which case it may be easier to not itemize given these standard deductions. And we'll see how this plays out in 2026 if there's any updates to this or complete changes to the tax code going forward. Head of household, it's jumped up again to $21,900 as well. And we'll take a look at the tax brackets here shortly and kind of see how that plays out for the different brackets you're in as well. Looking at these brackets, again, this is kind of a busy screen here. But again, no changes in the actual tax brackets themselves. The 10 to 12 to 22, 24%, 32%, 35, and 37% brackets, those are still the same. It's just the levels as far as income earned before you get to those different levels has gone up quite a bit because of inflation we've seen in here as well. So let me kind of zoom in on some of this. Again, we talked about the standard deduction down there. Let's focus on that married individuals to give us a quick example. Again, we talked about $29,200. But let's see that 12% to the 22% tax bracket jump. You can see somebody at the top of that 12% is going to be at $94,300. You add $29,200 to that, you're getting up to $123,000 $123,500 before you jump into that 22% tax bracket. So again, a very good level to focus on and have conversations around Roth conversion strategies if you're in that tax bracket. We'll talk a little bit later about some of those, but typically I like to talk to people that if they're in that 12% tax bracket, I'd probably argue that's the lowest you've probably seen in your life, and it might be the lowest you ever see again. So if we can maximize that, let's say somebody is maybe at $90,000. That means they've got another $33,000 or so they could go before they hit that 22% tax bracket. So it may be beneficial to do a Roth conversion, pay that 12% taxes on there, and get that moved over to a Roth. Minimize what you have to take out at RMD time, and also maximize that tax-free growth for yourself and for your beneficiaries down the road as well. Also, if we look at the long-term capital gains rates, again, still 0, 15%, and 20%. Let's focus again on the married individuals. We're at that 94,000 level before you jump from the 15% to the 20%. And again, that's going to be looking at total long-term capital gains, dividends, and income to get you above that level. So this is something that comes into play when we talk to individuals about NUA. We do a lot of work with the oil companies, so there are some low-cost basis stock where we've got some NUA situations to discuss there as well. So just keep that in mind. We can dig into that in more detail with you as well. Now, as far as the marginal tax rates, again, we talked about the top still remaining there at 37%. There are adjustments across all income tax brackets. That was simply just the marginal, the income limits have gone up because obviously we've seen inflation over the last couple of years here. And we'll talk a little bit about strategies to reduce some of those taxes. Again, I just talked a little bit about Roth conversions and the ability to do that in order to reduce some of those. But there's definitely some others to review when it comes time to focusing on your taxes as well. As far as one of those, it's going to be focused on your retirement contributions. A lot of people hopefully have a 401k at the office they work at, or wherever they work at, whether it be an office or somewhere else. You're going to be having that ability to make those 401k contributions on a pre-tax or post-tax or maybe a Roth basis, but that's one way to minimize some of those taxes, making those pre-tax contributions, whether it be in a 401k, 403b, or whether it be an IRA. Those limits have gone up as well. We're at $23,000 for 401ks, 403bs, and 457 plans. The IRAs are up to $7,000, and for those of you that are a little bit older, that are over 50, there's a catch-up option where you can actually add an additional $1,000 to the IRAs or an additional $7,500 to the employer plan. So somebody in a 401k that's 51, 55, 60, 70 could actually be putting that 23 plus 7,500, so 30,500, getting that deferred and deducted from your taxes whenever you look at that. So it's also really important to understand the aspect of increasing your contributions. A lot of times if you've started out a 401k, you may start low, 5 or 6 or 7%. Hopefully your company's got one of those options where they incrementally increase those every year. Maybe it goes up by 2 or 3% every year. So if you can afford that, get that saved. And if you have questions about that, we can always run reviews to show you how the incremental savings can impact you over the long term as well. Now, the gift and estate tax, this again, we talked a little bit about potential tax changes coming in 2026. That sunset of the Trump tax changes expires in 2025. We're here in the middle of this election season. We'll see kind of what happens there, but also what happens with Congress to determine whether or not after 2025 those actually do get sunset. We go back to some of the old rules, or if they implement those for a more permanent or just extend them for some time. One of the biggest things to be aware of or worried about is if you've built up a pretty good nest egg is the estate tax limits and gift limits there. That's gone up quite a bit to $13,610,000. Now, if we were to fast forward and we were to sunset and go back, that's going to get cut more in half. I think it's going to be, with inflation adjustment, go down to about 5.5. I think maybe 5.4 million, something like that. I'd have to go back and double check, but it's definitely going to be a big drop in there. So it's important to kind of run and review this. And if you want to get into the estate planning aspect, any of our advisors can kind of walk you through that. We can also, we got partnerships with estate planning attorneys on staff where we can actually run a full analysis, give you a flow chart, show you how your current estate plan looks, what some different changes in trust documents could be in order to solidify that, make it better. How does it look under the current estate tax limits versus if we were to sunset, how would it look? So we can go through all those different things with you. But again, it's good to plan for that tax efficiency and run that to know what happens on either side. The gift tax, the exclusion is $18,000 per person. So what that means is if you don't go over that, you're not going to have to tap into your gift tax credit, which again goes against your estate tax. So let's say you want to give your adult son some money, you can give them up to $18,000 without any issues there. If you're married, the two of you can do so. So you can give them $36,000. If he's married, you can give the spouse another 36,000. So that's 72 grand you can give them without having to worry about it going against any gift tax credits. If they got kids, you can do that too. So there's definitely some options to gift some of that money. And if you get into 529 plans for the grandkids, they even let you front load those with 5 years of gift tax exclusion. So a lot of things to kind of be aware of there. I just had a discussion with somebody last week about that, as far as trying to make sure they can take care of passing something on to the beneficiaries, especially the grandkids. And we had that conversation of, well, there's ability to do some of that now, so you can at least maybe get a little bit more props for what you're doing versus whenever you're dead, passing it on to them, making sure that you can enjoy some of the things you're giving them, and they can hopefully be more appreciative of that while you're still here. Now, as far as some different tax special provisions, we're not going to go into all of these because there's so many that are out there, but some of the ones we do see with people is the adoption credit's been bumped up again to $16,810. So if you're if you unfortunately can't have a child and you're looking to adopt and you go through that process, there's benefits there as far as that credit. Foreign earned income is something we deal with a lot, especially with a lot of our oil companies where individuals are working overseas. Now, a lot of times those companies will have their tax preparers handle that for you, but it could be that you've retired, you still have some income coming in. Maybe you've done some investments, bought some property over there. You're generating some taxable income over there. You're having to pay taxes to that foreign government versus being able to come back and exclude those. That's up to $126,500 now. So again, we can dig into those. And then there's a lot of different other special tax situations. Like I said, we're not going to dig into because there's too many to name. But if you have any questions on that, want to dig into it, let us know. The advisors here can walk you through that. Or if we need to get one of our CPAs on a call, we can do that as well. As far as the strategic planning and preparation aspect, again, we talked a little bit about some tax planning tips. Talked a little bit about that Roth conversion. There, we want to talk about preparing for the tax season. We're essentially kind of in the middle of it right now, here coming towards the end of July, but it doesn't mean that you can't prepare for next year. Again, some of you may have actually filed extensions, or maybe you got business taxes that are not due just yet. So again, you could still be in the thick of it. And then we'll talk a little bit about the kind of the conclusions and the next steps you need to be focusing on there as well. So tax planning tips. Leverage the increases we see in the deductions and the exclusions that we just kind of talked about. A lot of that's just inflation's been up, so those brackets have gone up a bit. Again, the actual bracket doesn't change, but the earned income. So again, you may be able to convert more than you thought, or even have that conversation about a Roth conversion. You may be able to gift more than you thought. So we can get into all those different options. Review your investment strategies. So whether it be that all your money's tied up in IRAs or 401ks, whether you've got some after-tax money in a brokerage account, you may want to be looking at tax loss harvesting. We talked about the dividend and long-term capital gains treatments. Maybe those are higher than what you expected. You want to realize some of those and keep yourself in a certain tax bracket. We can go through all those with you as well. But ultimately, at the end of the day, you might want to consider a consultation with a tax advisor if your situation is very simple and you're just living off Social Security and maybe take a little bit out, maybe you can do it yourself. But if you got some other complicated situations, maybe you're in that transition from working to being retired, you want to minimize your RMDs, you want to maximize Roth conversions, things like that. It's important to talk with a specialist, whether it be myself or one of the other financial advisors here at the retirement group. We can run through a high-level overview of some different tax planning strategies. And if we need to get one of our CPAs on the line, we can dig into that as well and go into more details for you there. So again, we talked about tax season. They got April 15th up here. Like I mentioned before, we're kind of in the middle of that. If you did file an extension or if you're doing business taxes. But wherever you stand, make sure you organize everything. Get prepared early. Most of your documents, excuse me, most of your documents, from companies will come out, late January or early February, so you can get most of that kind of in line and get that prepared and ready. And like I said before, you can consider professional tax help. Whether you just go through TurboTax or do some of the online ones or H&R Block, whether you work with us or another local CPA, make sure they cover some of those different options, some of the different changes in deductions, credits, nuances. But typically we go through all those with you on there. And then ultimately, kind of a quick conclusion is a quick recap of the 2024 changes. There really aren't any changes. It's really just a lot of things are indexed up for inflation. So again, but if you haven't really looked at it, or maybe you have been having work take care of things, now you're retired, you need help, go ahead and dig in there and make sure that you realize with inflation, some of those tax brackets have adjusted, and you can possibly be in a lower tax bracket than what you thought before. Another thing to look at, I didn't really put in here, or we didn't put in here, is if you're 65 or getting close to 65, that's another thing to be aware of. IRMA. That's going to be the taxes, or the amount of taxes you paid that generate how much you're going to have to pay for Medicare premiums. So something to be aware of, especially if you're doing large Roth conversions, and we can get into that one-on-one. And then obviously proactive planning. Whether you want to give us a call, kind of dig through some of this, you might be able to see if there's some outside of the investment strategy, some uncovered tax planning strategies to look at, or just kind of go through again with your CPA. Don't wait until February or March where they're slammed. Talk to them before the end of the year and see if there's any strategies you can look at before the end of the year, and then be all prepared and ready to go for the first quarter. So that's going to be easier for you at that time. And then, like we said, generally speaking, it's just a plan. Right now, about 3/4 of Americans over 50 don't have a written plan. If you can spend about 10 to 15 minutes with us, we can gather some data, run a full cash flow analysis for you, which will give you a better idea of your overall situation. I really kind of help you determine different things about when should I retire. Should I take the pension if I have that as an annuity or a lump sum? What should I do with my 401k? How are the taxes going to play into this? We can go through all those different options with you if you spend some time with us, and that's all complimentary for you as well. But again, a quick reminder who the retirement group is. I know a lot of you have talked to us before, but we are an independent financial advisory firm that focuses on working with corporate employees, helping you transition to retirement, helping you understand your benefits. Myself and a lot of our advisors focus on just a select few companies. That way we have a good understanding of your benefits inside and out, whether we're helping you with your pension, your 401k, your healthcare retiree medical benefits, life insurance continuation, any of those things we can help you with that. But again, it's important to run that cash flow analysis to kind of get a big picture of everything. I mentioned that's something that's complimentary. So just take us up on that. And if you're trying to figure out, should I retire this year or next year, or in 2027 versus 2028, can I retire and go work somewhere else? We can go through all those different scenarios with you. And we do have offices throughout the country, so rest assured if you need to sit down with somebody face-to-face, we can likely accommodate that. But obviously, if you want to do this via phone calls or web meetings, that can be done as well, whatever your preference is. I'm going to wrap this up, and like I said before, and sort of instead of going back and forth, on this call, I'm going to take a look, see if we did have any questions. I just saw one that did pop through, so I'll answer that in just a moment. But if you do have any questions, you can reach out to us at 800-900-5867. You can also schedule a meeting by using one of the QR codes here to get into our calendars, or you can also use the other one to get into our LinkedIn if you want to stay updated on more company-specific information. You can also reach that info@theretirementgroup.com. So that one question that came through was, I know I talked about the Roth conversions, but that question came through was, what's the max that I can convert in a year to my Roth IRA? So I didn't really kind of dig into this, but at this point, there's really no maximum. It used to be the max you could convert was $100,000. So I gave the example of, let's say somebody who's a married couple and they're at $90,000 of income, and the top of their marginal tax bracket is 94 and change plus the standard deductions, so they could do about 123 or so, which means they could add another 33,000 roughly and get that at that 12% tax bracket. But let's say they did 100,000. What would happen is that 23 would be at that 12% tax bracket, and the rest would be at that 22. If they did $1 million, then they'd be at the 12%, 22, 24, 32%, and kind of step up from there, and that average bracket would come somewhere in between there. So there is no limit. You could do $1 million, you could do $5 million, you could do $10 million if you have it. But the problem is, the more you do, the more you'll pay in taxes right now, and that's going to be a bigger bullet to bite. But we can always run a scenario to kind of show you all the different levels and provide you with those different options on the Roth conversion strategy. So just give us a call to look at that. Great question. I'm going to wrap that up, and just again a quick reminder. I think Samantha mentioned this before, but even though we worked extensively with a lot of Fortune 500 companies, that does not mean we are endorsed or employed by them. But obviously, if you have any questions on the taxes, the Roth conversion I kind of talked about, but also your company plans and retirement planning, just reach out and give us a call at 800-900-5867. Thank you and have a great day.